For the past few months, the US dollar has been surprisingly stable. Despite Trump's attacks on the Federal Reserve and his broader assault on the global order, the market reaction has been weirdly muted. Not much changed for half a year. That was until last week, when the dollar suddenly collapsed, suffering its steepest one-week decline since probably Liberation Day. So we're going to break down this sudden crash and try to figure out what's actually driving it. Let's start with some context, because understanding the dollar's recent trajectory requires looking at how we got here. The best way to measure the strength of the US dollar is through something called the dollar index. This basically measures how strong the dollar is against a weighted basket of other major currencies, including the euro, Japanese yen, British pound, Canadian dollar, Swedish krona, and Swiss franc. Each currency is weighted differently based on its importance in international trade. The dollar index is considered more reliable than just comparing the dollar to one other currency, because one-to-one comparisons tell you as much about what's happening with that other currency as they do about the dollar itself. If the dollar weakens against the euro, for instance, it could just mean the euro is having a strong day, rather than the dollar actually struggling. But if the dollar falls against a whole range of other currencies simultaneously, that's pretty solid evidence it's genuinely getting weaker. According to this index, the dollar actually had a bit of a boom when Trump first came into office. It started rising in September 2024, when polls first showed Trump might win, before hitting a 2-year high in January as he took office. This happened partly because of genuine optimism in the business community about Trump's promised tax cuts and deregulation. Corporate America was excited about the prospect of lower taxes and less regulatory burden, which typically boosts corporate profits and makes American assets more attractive to investors. But the rally was largely because markets believed Trump's threatened tariffs would do more damage to other economies than to the US, which made the dollar more attractive relative to other currencies. The logic was straightforward. If Trump imposed massive tariffs on Chinese goods, European cars, and Canadian imports, those economies would suffer, while America would be somewhat insulated. Foreign investors would flee those markets and park their money in dollar-denominated assets as a safe haven. This is classic dollar strength, driven by relative weakness elsewhere. However, there was a steep and persistent decline after Liberation Day, when markets lost confidence in Trump's economic policies. Liberation Day was when Trump announced his comprehensive tariff package, and markets quickly realized this wasn't just tough negotiating rhetoric. This was actual policy that would disrupt global supply chains, raise consumer prices, and potentially trigger retaliatory tariffs from major trading partners. The initial optimism evaporated as the reality set in. The dollar did stabilize in July, both because Trump backed down from some of his more extreme tariff threats and because the American economy proved surprisingly resilient to tariff-related disruption. But in the past week or so, the dollar has cratered again, suffering its steepest decline since Liberation Day. If current trends continue, by the time you're watching this, the dollar could be at its lowest point since early 2022. What makes this even more concerning is that the dollar index might actually be understating the dollar's current weakness. The index only measures the dollar's decline against other currencies, not against other reserve assets like gold and silver, both of which have absolutely skyrocketed against the dollar recently. That's a bad sign. So what's driving this decline? We can identify at least 3 immediate causes, each representing a different dimension of the crisis facing the dollar right now. The first is Trump's aggressive moves toward Greenland, which sparked serious talk of a transatlantic trade war and probably triggered the initial sell-off. Trump's renewed interest in acquiring Greenland from Denmark wasn't just an eccentric real estate fantasy. It represented something much more troubling to markets, a willingness to fundamentally disrupt relationships with America's closest allies in pursuit of territorial expansion. When Denmark refused to even discuss selling Greenland, Trump didn't just back down quietly. He threatened tariffs on a NATO ally, suggested the U.S. might reconsider its commitment to defending Denmark, and made comments that allies across Europe interpreted as threatening. This wasn't just about Greenland. It was about whether the United States could still be trusted to maintain the international order it had built and defended for 80 years. Markets don't like uncertainty, and they especially don't like unpredictability in the country that issues the world's reserve currency. Trump did eventually back down from the most extreme threats, but as evidenced by the fact that the dollar didn't recover, this hasn't been enough to calm the markets. Markets seem permanently spooked by Trump's imperial instincts and his wider disdain for what's called the rules-based international order. Once that trust is broken, it's very difficult to rebuild. The second cause is the Japanese yen, and this is where things get technically interesting. As much as the dollar index tries to guard against this, at least some of the dollar's relative depreciation is a consequence of the recent appreciation in the Japanese yen, which makes up about 15% of the dollar index's basket. For context, the yen has had a brutal couple of months, falling from about 145 to the dollar in September to nearly 160 earlier this month. That's a massive depreciation in a short period for a major currency. However, late last week, reports emerged that Japan's central bank, the Bank of Japan, had started intervening in the markets to keep the yen above the 160 mark. Currency intervention is a powerful tool that central banks rarely use because it's expensive and doesn't always work. They've been spending their foreign currency reserves, primarily dollars and euros, to buy up yen and push up its value through sheer market force. When you increase demand for something, its price goes up. That's exactly what the Bank of Japan is doing. There were even reports that the U.S. was actually helping the Bank of Japan in its defense of the yen, which is absolutely remarkable when you think about it. This is happening for 2 reasons. First, because the Trump team thinks a weak yen gives Japanese exporters an unfair advantage over American competitors. A weak yen makes Japanese cars, electronics, and machinery cheaper for American consumers to buy, which Trump sees as Japan manipulating its currency to steal American jobs and market share. Second, because the recent sell-off in Japanese assets had sparked panic in global bond markets, which spread to the U.S. Treasury market and pushed up American borrowing costs. When Japan's massive government bond market becomes unstable, it sends shockwaves through global fixed income markets, because Japan is one of the largest bond markets in the world. The Bank of Japan's intervention has apparently boosted market confidence, with the yen rising to about 154 to the dollar. And this has obviously pushed the dollar index down. It's also worth noting that the Swiss franc, which makes up another 4% of the basket, has also had a strong couple of weeks. Investors are clearly feeling nervous, and the Swiss franc has a reputation as the safest currency around. So that's the second immediate cause, the recent appreciation in the Japanese yen, and to a lesser extent, the Swiss franc. The third immediate cause, however, is the prospect of yet another government shutdown in the U.S., and this one carries particular symbolic weight. In the aftermath of the killing of Alex Prey, who was fatally shot by Border Patrol agents in Minneapolis over the weekend, Democratic lawmakers have announced they won't support legislation that includes funds for the Department of Homeland Security until the Trump administration reins in Border Patrol and ICE. This is a principled stand on a deeply emotional issue, but it also creates an immediate fiscal crisis. This leaves Congress with only a couple of days to hash out an agreement before a government funding deadline on January 30th. Otherwise, the government shuts down. Government shutdowns are generally bad news for the U.S. economy, and thus bad for the dollar, because they signal political dysfunction, disrupt economic activity, and shake investor confidence. Federal employees don't get paid. Government services stop. Economic data stops being collected and published, which creates information uncertainty that markets hate. But market nerves have also been amplified by the wider political dysfunction in the U.S., as evidenced by the fact that we're on the cusp of our second shutdown, barely a year into Trump's term. The first shutdown happened just months ago over budget disputes, and now we're facing another one. This pattern of recurring shutdowns, partisan gridlock, and inability to perform basic governmental functions sends a terrible signal to international investors. If the United States can't even keep its own government funded and operational, how can it be trusted to maintain the stability necessary for reserve currency status? The instability is clearly rattling investors who are used to thinking of America as the world's most stable, predictable democracy. So those are the three immediate causes we can identify. Trump's revealed disdain for the rules-based order, the intervention to support the yen, and the renewed threat of a government shutdown. But there are also what we might call background pressures on the dollar worth mentioning. For starters, Trump's ongoing assault on the Federal Reserve has provoked serious anxieties about the prospect of inflation eroding the dollar's real value over time. Trump has made it abundantly clear both that he wants lower interest rates and that he's willing to put pressure on the Federal Reserve to get there, despite the fact the Fed is nominally independent. A Trump-led Fed would mean lower interest rates and thus probably higher inflation. That makes holding dollars less attractive long-term. Furthermore, the dollar's appeal as a reserve asset seems to be genuinely waning, and this is perhaps the most consequential long-term trend we're discussing. Since at least the end of World War II, the U.S. dollar has been the world's dominant reserve currency. In other words, it's the currency that central banks and other big financial institutions prefer to hold in their foreign exchange reserves. When a country wants to have savings for a rainy day, When a central bank wants to intervene in currency markets, when international institutions need to hold liquid assets, they overwhelmingly choose US dollars. This status has given the United States extraordinary advantages. It means the US government can borrow money more cheaply than any other country because there's always demand for dollar-denominated debt. It means American consumers can buy foreign goods at lower prices because international trade is conducted in dollars. It means American banks and financial institutions have privileged access to global capital flows. It's been called an exorbitant privilege by French economists, and they're not wrong. The dollar is still the global favorite, but it's less popular than it once was, and the trend is accelerating. According to the latest IMF data, the dollar's share of global reserves has slumped in recent months, falling to a 30-year low in mid-2025, the latest period for which data is available. That's not just a statistical blip, that's a structural shift. Central banks in China, Russia, India, Brazil, and even some European countries have been quietly diversifying away from the dollar, increasing their holdings of euros, yuan, gold, and other assets. All else being equal, less demand for dollars as reserve assets obviously means a weaker dollar. But it also means something more profound. It means the world is hedging against American economic and political dominance. It means other countries are preparing for a world where the dollar isn't automatically the safe choice. And once that psychological shift happens, it's very difficult to reverse. What we're watching is potentially the beginning of a significant shift in global currency dynamics. The immediate triggers, Greenland, the yen intervention, the government shutdown threat, these are just symptoms of deeper structural problems. Trump's assault on international norms and institutions, his pressure on the Federal Reserve, the growing political dysfunction in Washington, all of this is eroding confidence in the dollar as the world's safe haven currency. The dollar has enjoyed reserve currency status for nearly 80 years, and that status has given the United States enormous economic and geopolitical advantages. It means the U.S. can borrow cheaply. It means American consumers can buy foreign goods more affordably. It means the U.S. has disproportionate influence over the global financial system. But reserve currency status isn't a birthright. It's earned through stability, predictability, and trust. And right now, all three of those qualities seem to be in short supply. Markets are forward-looking. They don't just react to what's happening today. They price in what they think will happen tomorrow, next month, next year. And what markets seem to be pricing in right now is continued instability, continued political dysfunction, and continued erosion of the institutional frameworks that have underpinned American economic dominance since World War II. The question isn't whether the dollar will remain the world's reserve currency forever. History shows that reserve currency status always eventually shifts. The British pound held that position for decades before the dollar took over. The question is how quickly that transition happens and what it means for average Americans when it does. A weaker dollar has real consequences that touch every American's life, whether they follow currency markets or not. It makes imports more expensive, which drives up inflation. When the dollar weakens, that iPhone from China costs more. That German car costs more. That bottle of French wine costs more. All of those price increases feed through into broader inflation, which erodes purchasing power and living standards. It makes foreign travel more costly, turning what might have been an affordable European vacation into a luxury expense. It can trigger capital flight as investors move their money to safer, more stable currencies, which can create a vicious cycle of dollar weakness. And if the dollar loses its reserve currency status entirely, the consequences would be transformative. The U.S. would lose the ability to borrow at preferential rates, which would have massive implications for government spending, interest rates, and the broader economy. Right now, the U.S. government can run large deficits because there's always international demand for Treasury bonds. Without reserve currency status, that demand would dry up, forcing either massive spending cuts, much higher taxes, or both. Interest rates would rise dramatically, making mortgages, car loans, and business borrowing much more expensive. We're not there yet, and it's important to be clear about that. The dollar is still the dominant global currency by a significant margin. Most international trade is still conducted in dollars. Most central bank reserves are still held in dollars. Most commodities are still priced in dollars. The dollar's network effects and institutional advantages don't disappear overnight. But the trend lines are concerning, and last week's crash is a warning sign that shouldn't be ignored. The foundations of American economic power are being tested in real time, and the outcome of that test will shape the global economy for decades to come. What we're witnessing might be remembered as the moment when the world started seriously hedging against American economic dominance, when central banks began diversifying away from the dollar in earnest, when the assumption that the U.S. dollar would always be the safe haven currency started to crack. It's similar to what happened to the British pound in the early 20th century. Britain was the dominant global power. The pound was the reserve currency. And then slowly, gradually, through a combination of economic mismanagement, political instability, and rising competitors, that status eroded. By the time World War II ended, the dollar had replaced the pound as the world's reserve currency. That transition took decades, but it was real, and it was irreversible. The immediate causes of last week's decline will fade from the headlines. The Greenland crisis will be forgotten. The yen intervention will stabilize. Congress will probably avoid a shutdown or end it quickly. But the underlying erosion of confidence in American economic and political stability, that's the story that matters. And it's a story that's only just beginning to unfold. The question facing policymakers and investors isn't whether the dollar will face challenges. It's whether American leadership has the wisdom and discipline to address those challenges before they become irreversible. Based on recent evidence, that's an open question with no clear answer.